In this video, we will discuss receivables. We'll be working in Chapter 8, and we'll discuss several different types of receivables, and then how to account for receivables that can't be collected or uncollectible accounts. So what is a receivable? A receivable happens when we have sold something to a customer on credit, so that could be services or goods. So that means the customer did not pay us cash now. That means we billed them and they will pay us later. Some other terms to note is a receivable has two parties. We have a creditor and a debtor. The different types of receivables that we have accounts receivable and notes receivable, and some other types of receivables. For accounts receivable, that is where we have sold something to a customer on credit, and that's usually for our revenue or something that we have sold. And those are short-term things. We usually only bill customers, and they usually have to pay us within 30 to 60 days. Also, with accounts receivable, there are some implied terms there. We call those trade receivables, but these are not the same as what we'll talk about next with notes. It's not as formal an arrangement, and we're typically not charging interest on accounts receivable. We may charge some late fees and things like that if they're not paid, but typically we're not trying to make money by recording interest. Whereas notes receivable, on the other hand, they have longer terms than notes receivable, and they would usually have a written promissory note to go with it. You will have a maturity date. That's when the date and the note is due, and you will have principal plus interest. Again, these are longer term than our accounts receivable, and they usually have specified terms like a fixed amount of interest, a certain interest rate, and they have a maturity date. We can also have other receivables on the balance sheet, for example, interest receivable, and we talked about that when we talked about adjusting entries. So we can have several different types of receivables. Remember that accounts receivable or notes receivable, those are both assets, and their normal balance is a debit. So just a reminder, when we record sales on credit, we debited accounts receivable. That's to increase the accounts receivable with a debit, and we record revenue. So we record the revenue when it is earned, and so the payment can possibly come later. Within our accounting records, we have the general ledger. That's where you're going to find the balance of accounts receivable, but we also have subsidiary records or accounts. And a subsidiary ledger will contain the details of all the different customers that we have sold to with credit. So that would be, for example, you have here, the accounts receivable is the control account. This is the total balance of all accounts receivable for the company. And then we break it down by customer. Accounts payable would work the same way. That's not in this chapter, but accounts payable also has a control account and a subsidiary accounts with each of our vendors' balances as well. So when we collect money from the customer, what we've seen before is we debit cash and we credit accounts receivable. And we hope that that is the process and that everyone pays us. Next section we'll talk about is factoring and pledging receivables. Receivables are assets, so we can sell receivables, and we can also pledge them as collateral. So when we sell receivables, we call that factoring. And when we pledge receivables, that means that they are using this as collateral or security for a loan. So we have different things that can happen. So we can go borrow money and use this asset of receivables as collateral toward that loan. We can also sell our receivables to another company. Now what would happen is that company would not pay us the full amount because they are taking on the risk. The person that is buying the receivables rather, is called the factor. And there can be certain terms on that. So when we sell those, the factor takes on the risk of collecting. So, for example, they may only pay us 97% or 98% of what our receivables are worth. Also, the factors can put in some terms. If there are certain customers that repeatedly did not pay, they can choose not to honor that or buy those receivables. So we have the issue of some customers will not pay us, and there's some reasons that that can happen. That could be a company maybe filed bankruptcy, so something has happened and the individual's on hard times, they won't pay us. But we can't leave these receivables on our balance sheet forever. So we're going to be talking about two methods of working with writing off receivables. And the first one is the direct write-off method, and the second one is the allowance method. So we will discuss the write-off method. It is not, however, GAAP or fall under generally accepted accounting principles. Our direct write-off method can be used by smaller companies that use the cash basis. And so let's talk about how the direct write-off method would work. We have an example where Smart Touch Learning had let the customer buy something on credit for $200. So they would have originally debited accounts receivable and credited their revenue account. So under the direct write-off method, when we find out that the customer cannot pay, whenever that time period is, we find out they can't pay, which may be 90 days, 180 days later, we're going to debit bad debt expense and credit accounts receivable, and that will write off the uncollectible account. If the customer later comes back to us and says, you know, I can pay, or maybe they can only pay part of their amount that they owe us, to record that and reinstate that account that's previously written off, we will put it back in accounts receivable as a debit, and we will credit bad debt expense. And notice that's just the opposite of the journal entry we did to write it off. You basically are reversing it. And then you record the cash to collect it and then credit the accounts receivable. So you can follow along with the note pages that I have. We've discussed the types of receivables. We've talked about factoring and pledging receivables. And this is the direct write-off method. It is used by our smaller companies that follow the cash basis. The limitations of this is that expense related to that revenue is reported in a different time period. So our expenses do not match the time period that our revenues were recorded. Okay. So just to recap what we did, if we record something on credit, we debited accounts receivable. And we would then credit sales revenue. And then if we write off an account, we find out later, that's probably at least going to be a minimum of 30 days, probably 60, 90 days later. We've tried every avenue there is to collect. And if you're a small company, if a customer doesn't pay you, you'll keep a record of that. You would probably call them several times and request payment. Then I would suggest you send a certified letter, because you're going to need to show that you tried to collect the money from them. And then if the customer still doesn't pay, of course, we probably won't sell to that customer again. but we may have to take them to small claims court. Now, you would have to weigh the pros and cons of, do I want to pursue collecting from the customer when I've got to pay attorney fees and court costs? But that is an option. You can go to small claims court potentially for that. When we write off the account, we would debit bad debt expense, and we would credit accounts receivable. And that would be all that would happen unless the customer comes back and says, you know, I can pay that. So what we would do is debit accounts receivable, and we would credit bad debt expense. And then with the cash that the customer paid us, again, this might be in part or in full, we would debit cash and we would credit accounts receivable. So by taking those notes, you will have something to work with as you look at your practice and homework problems. Just when you start your exercises or problems for this chapter, always be sure and identify which method that you're working with. This is the direct write-off method, and again, it is only used by companies that usually follow the cash basis. In the accrual basis, we have to follow a little different format because the limitations of the direct write-off method is those expenses recorded for bad debt expense does not match the time period in when we recorded the sales revenue. So next, let's talk about the allowance method. With the allowance method, we're going to use a new account called a contra asset account, and it's going to be called allowance for bad debt, or you could also call that allowance for uncollectible accounts. We're going to use allowance for bad debt in this textbook. So companies that follow GAAP, we are trying to match our expenses with the time period that we recorded our revenues. So we have to estimate the amount of people or percentage of receivables that will not be collected and make an adjustment for that. So let's take some notes on this section. Again, the allowance method is GAAP. That means we're following generally accepted accounting principles. We're using a new account called Allowance for Bad Debt. And this is a contra asset account. And it has a normal credit balance because it offsets our accounts receivable account on the balance sheet. We're going to look at 3 different options under the allowance method. So companies would pick one of these options and use that. We don't usually typically keep changing back and forth. One option is we're going to look at is the net sales method. Then we're going to look at aging of receivables. And the third one would be percent of receivables. So net sales method, percent of receivables, and aging of receivables. No matter which 3 of these options that we pick, the journal entries are going to look the same. It's just the process to get the number is going to be different. So let's have and take some notes and talk about what the journal entries look like. If we record the sales on credit, we're first going to debit accounts receivable. and we would credit sales revenue. To estimate the bad debt expense, we're going to debit bad debt expense, and we are going to credit this new contra asset account called Allowance for bad debt. So this is a contra asset account. By doing it this way, under the allowance method, we have recorded this bad debt in the same time period that we recorded this revenue. So for example, at the end of every month or time period, we will make an adjustment and we will record the bad debt expense, and then our allowance for bad debt will be recorded as a credit. Now, what our accounts receivable is going to look like on the balance sheet, we're going to show accounts receivable, and we're going to subtract allowance for bad debt. So if my accounts receivable balance was, let's just say, $90,000, and my allowance for bad debt was $3,000, we are now going to report on the balance sheet net receivables of $87,000. Now, how this is more useful is, again, we've already recorded the expense in the time period that we recorded the revenue, so that makes us follow the matching principle, but also it gives our users of our financial statements a better indication of, we're not really expecting to collect $90,000, we are expecting to collect $87,000. So we would show those net receivables. And so companies have to estimate this amount. This is simply an estimate. We still hope to collect all $90,000, and this estimate can be based on past experience. Now, under the allowance method, when we write off an account, what we will do is a little different than the direct write-off method. We will debit the allowance account that we created, allowance for bad debt, and then we will credit accounts receivable. Then if we have, the next part is, if we have the recovery of our accounts previously written off, the next step here will be debit accounts receivable and credit allowance for bad debt. We would put it back in accounts receivable to reinstate the account. And then we would debit cash rather, and credit our accounts receivable when the customer pays. Okay. So to recap, we would debit accounts receivable and credit sales revenue to record our sales on credit. To estimate the bad debt, we would debit bad debt expense and then credit our new contra asset account called allowance for bad debt. If we are going to write that account off, we would debit allowance for bad debt and credit accounts receivable. And that may be the end of it. The customer never pays us. But we cannot leave that receivable on the balance sheet indefinitely if we're not going to collect that. That would be overstating our assets. And then if we have recovery of a previously written off account, we will debit accounts receivable and credit the allowance for bad debt. And the customer payment looks the same as we've seen before. You would then debit cash and credit accounts receivable. So this is just a good overview of getting started with Chapter 8. And we've got some notes there for you to work with as you do your problems. The next video that you will see will show you how to record and work with the net sales method.